Good day to one and all. This is Dr. Sivaraman of IKnowIndices.com. So I'll be presenting the monthly one swing webinar, Tracking the Forex Market Together, part 1 between 9 and 9:45 GMT on 10th of June, that is today, and part 2 between 13 and 13:45 GMT. That will be the late European and the gap time and the US session. So I'll be explaining to you my trading system, a simple market trading technique. And in this, we follow the three components, namely the derived forecast. The forecast is derived using specific statistical algorithm and which is given in FX Street on Mondays as Asian session live market analysis. And during that time, I give the forecast for the entire week. And that also gives the session-wise moves. So here, this is the forecast I have given it on 9th yesterday, that is Monday, how exactly the market is expected to make the swings and slides or rise during different parts of the day. And today we are on 10th, and the market was expected to make the swing and slide during the Japanese session, and again swing and slide during that of the European session. Now we are at the European session. So we are at 9 GMT. The European session starts by 7:30 GMT. 7:30 to 9 GMT is the early part of the European session. So the market has already started making the slide. So the expected slide, they just done it. So we will try to find out how exactly we are going to make the trades. So after taking the forecast into consideration, we don't trust it 100%. We wanted to do the market reading, try to find out how exactly the market is expected to move, because the forecast gives much in advance the expected market moves for the entire week or for the month or the year. But ultimately, what is more important is the level of volume we come across from time to time. So if suddenly the volume depletes, then the market swings might get subdued. And if the volume increases, then suddenly we could come across big volatile moves. And those things cannot be envisaged by that of the forecast algorithm. The volume change from time to time. Any type of analysis will not be in a position to take into consideration the volume variation, and that we call it as a dynamic variation. So when there is a volume variation, then we need to find out how exactly the market is expected to behave, how much of pips it is expected to drop and the rise. We need to do it with the help of the market reading technique. And what is that market reading technique? We try to identify how exactly the players are expected to make the moves in the market. So for that, we note down the session-wise timings of the market, the Japanese, European, and the US sessions. So Japanese session is from 0030 to 7 GMT, and 7:30 to 13 GMT is the European session. And today, from that of 9 to 9:45 and 13 to 13:45, I'll be giving the part 2 of the webinar. So now I'm giving the part 1 of the webinar. So after identifying the timings, we need to go in for the live market code page. In the live market code page, you come across the 4 majors and the 2 commodity pairs are being listed, and their bid and the ask are given, and also the high and the low, and also the net change, and then the GMT time frame. Unfortunately, this is showing now the Eastern time. So we have to go in for the GMT time, which we come across in the homepage of fxtrade.com, and there you can just find out it is 9:04 GMT. So once you open up the live market code page, and I can give the link if you want. Then what happens? We try to find out where exactly the market is, and also how much of pips that correction or the firming up have happened. And in order to have a relative comparison, what we note is the lows and the highs, they set around 3:30 GMT. The players set the lows and the highs for the day around 3:30 GMT when the volume improves on a daily basis. So between 2:30 and 3:30 GMT, they set the low and the high. So they take about 1 hour and then they try to set the low and the high. Then afterwards, we have to find out whether they breach the high and go above or breach the low and go below, and how many hours they are staying or how many minutes they are staying below that of the low or above that of the high. And identifying that duration, we'll be able to recognize the type of moves. So actually, the type of moves I'll explain to you after referring to that of the initial lows and the highs in market trading technique. So euro formed today around 3:30 GMT. The low was 1.3587, and currently you find that they formed the new low 1.3556. So it has come about 30 pips below that of the initial low and staying around that of the new low. And the high, they just breached it by about 8 pips and then started making the slide. So by the end of the Japanese session, they just made one quick upward stop and then started making the slide. So we are able to understand very quickly, very clearly that they go above that of the initial high for a brief period of less than 30 minutes and then come below that of the initial high and come below that of the initial low and stay below that of the initial low for more than 30 minutes. So when they make such upward stop and come down quickly and stay below that of the initial low, we try to identify that as an intentional move. They intend to make slow slide in the case of euro. Now let us see in the case of GBP. Now GBP formed the initial low 67.84 and they just breached the low and come above, and the high was 68.32, but that has not been breached. So when euro was making the slide, they also made the slide in the case of GBP and then firmed up, but they did not go and breach the high. So that means what? In order to bring in the variation with regard to the pip changes, there is 33 pips in the case of euro and 2 pips in the case of GBP. So when GBP has made lesser drop when compared to euro, what happens? GBP is relatively strong when compared to 1 hour time frame, and euro is slightly weaker. In that process, you find when GBP is strong in a euro GBP cross, when GBP becomes strong, you find euro GBP cross comes down. So now we are able to understand why there is a variation in the case of euro and GBP with regard to the pip change. It is simple because during that of the mid session after 9 GMT, they try to handle that of the crosses. So when they are handling the crosses, you will come across this set of pip variations in the market. Similarly, you come across here in the case of USD CAD a positive net change of 5 pips and also Australian dollar a positive net change of 2 pips. So Australian dollar is showing the USD weakening move and USD CAD is showing the USD gaining move, and this is referred as a contrarian move. When they make such contrarian move, we understand that they are handling the process. That is why you find that euro, GBP as well as USD are in negative net change. When euro and GBP are showing negative net change, it is a USD gaining move, whereas when USD is showing a negative net change, it is USD weakening move. But they just make a downward move in all the three in order to drop euro yen and GBP yen. 33 pips and 59 pips. So they have got a purpose for every move. And what is the purpose? In order to earn money. And how they earn money? They make the move against the expectations of the traders, so that the traders who have committed the positions vulnerably get trapped if they don't have appropriate trading strategies. So Now, in the case of GBP, they are holding above that of the initial low and not breached the high. And in the case of yen, 102.35 was the low, and they just breached the low and gone below, and 102.22 they showed, and then subsequently came up to 102.32, below that of the initial low. So below that of the initial low, they are holding it, and slowly they will make one more downward move when euro is making further drop. So that euro yen is expected to come down further. GB yen is also expected to come down further on the downside. So we will be able to identify in the majors what sort of moves they are doing it. Accordingly, we can also relate it what sort of moves we can envisage in the case of the respective crosses. Then in the case of CHF, 89.70 is the low, and they just breached the low, 89.64, and come above. Similar to that of the upward stop in the case of euro, they just made a brief downward stop and started gaining the levels. And then high was 89.74 around 3:30 GMT, but now 89.94 is the new high. And they are holding closer to that of the new high and staying above that of the initial high for more than 30 minutes in my observations. So they are expected to take it further upward. Then in the case of Canadian dollar, 1.0901 was the low, and they came down from there by about 10 pips. 1.0891, they just made a brief downward stop and gone above. And the initial high was 1.0909, but they breached high and gone above 1.0914 and staying above that of 1.0909 means they wanted to take up USD CAD. They are staying above that of the initial high for more than 30 minutes. Then Australian dollar, 93.41 is the low, 93.63 was the high, and they just breached the high and went up to 93.76 and came down below that of 93.63 and holding around 93.57.58. So they did not breach the low, but they breached the high and come down very quickly. That means they just made an upward stop during session start time and then started making the slide in the case of Australian dollar also. So what we understand with regard to the respective currencies, I explained it. Now we will try to find out the type of moves, and we can recognize what moves they are doing it. Now, stopping is a move which happens in less than 30 minutes above that of the initial high or below that of the initial low, and then reverse for about 15 to 25 pips. So they had done the upward stop during session start time in the case of euro, and the downward stop in the case of CH. So if you're a smart trader, what you are supposed to do when they are making the upward stop and take a sell position, and when they are making a downward stop and take a buy position, then we'll be able to really make a quick profit. So for that, we need to follow the live market quote page and also note down the initial lows and the highs around 3:30 GMT and how they are handling the initial lows and the highs. We'll be able to identify and easily related during different sessions during European as well as the US sessions, and see what sort of trades you can take. So when they are making an upward stop, and we know very well that they wanted to make a downward push. When they make a downward stop, and we are able to understand that they want to make an upward push. So stop is a quick move which happens for about 15 to 25 pips, and they reverse in less than 30 minutes. And a false move is the one which happens either up to that of the high or up to that of the low and reverse. In the case of JBB, they came up to that of the high, 68.32, but did not breach the high and came down. And so you find that they made the false move on the upside in the case of JBB and came down and breached the low, and subsequently they are holding closer to that of the initial low to make further moves during the late European session. Now, mid-European session, they will be handling the crosses. So if you try to take a position now, then we may have to wait till end of the session to book profit. That is why I always recommend the session-wise trade so that beginning of the session you can take the position and close it by end of the session with an adequate profit. Then they make moves more than 30 minutes up to 2 hours, which is referred as an extended move. That means they go above that of the high, stay above that of the high for more than 30 minutes, and after 2 hours, reverse. Now, in the case of USD yen, they just breached the low, initial low, 102.35, and then formed a new low, and they are staying below that of the initial low. But they have not cut the new low again. So we need to find out whether it is an extended move on the downside to make a rise again, or they wanted to make an intentional move on the downside continuously. If they stay for more than 2 hours below that of the initial low, and definitely they will make for the downward move as an intentional move. And the intentional move is the one which happens for 2 sessions. Definitely full complete 2 sessions. Where they have started with that of the European session, they will complete with that of the US session. Then the next day, they try to make one quick downward move and reverse upward. And if they have done the intentional upward move, then one quick upward move during the start of the third session, and then reverse quickly. And that is what the intentional move is. So third session, they reverse. So now the European session, they have started in the case of USD yen, a downward move below that of the initial low, staying below there for more than 30 minutes. And also in the case of Euro, they just breached the initial low and staying below there for more than 30 minutes. And similarly in the case of CHF, they just breached the high and staying above that of the high for more than 30 minutes. So we need to wait for 2 hours if they are not reversing it. And instead, if they just breach the new low in the case of Euro, breach the new low in the case of yen, and new high in the case of CHF, that means they wanted to make an intentional move for 2 sessions and the start of the third session. You need not ask anybody, you need not refer to any of these technical analysis. Simply, you can take a sell position in Euro after 2 hours, and definitely you will see 100% profit in it. And similarly, buy position in the case of CHF, you will see 100% profit. And similarly, in the case of yen, they just breached, they are not breached the high and gone above. Instead, if they just breach the new low, then they will make for the downward move. But the quantum of move, we need to measure it, but definitely the position will be making profit. So this is the intentional move. During the intentional move, if we take positions, we'll come across that really and slowly we'll be able to book profit without much of attention. Because during the other type of moves, you find during stop and or during that of the extended move, they are quick moves. False move, they are all quick moves. So during quick moves, what happens when they quickly gain the level, then your fear is triggered. And immediately you think that Euro could go up further high, further high, further high. And so you hesitate taking any position. But slowly, they just drop it. So if you are able to identify that it is a stop and that means if you become an experienced trader, in 10 minutes after forming the new high, if they are not breaching the new high, that means it is only a stop and they are going to reverse it. Quickly, you can take a sell position. And the only risk is they can further take it up. So if you use the hedging order to limit the risk, and if you are able to keep stop at entry once the position is making profit, then absolutely no fear. So during such quick moves, if you try to take a sell position on the upside, and during the quick downward move, you try to take a buy position on the downside, you will be able to really see that the position gives at least a nominal profit. So identify the quick moves or false moves in the market, and they just make such quick moves in order to trigger the fear of the traders. And you understand, okay, my fear is going to be triggered. I have control over my fear. I will not become afraid. I know very well they are simply making a stop and you laugh at them, you don't become afraid. Then you will feel like taking the appropriate position. But instead, you become afraid and immediately ask anybody how high euro can go, how high GBP can go. Then they will say it can go up to Mount Everest. And then you are not in a position to understand at all. You are under the full grip of emotion and also the fear. Then later on, when they start dropping that, then such traders who are not taken the sell position during the rise, immediately they find that, okay, they started dropping without understanding it as near stop, and then they go and sell after that drop. So that is again an emotional act, because they find that they are being cheated by the market and they do not want to leave the market and they wanted to take a real revenge. And so after the drop, they just go and sell. Then afterwards, the market is not dropping. So as long as such emotional traders are there who try to buy when they are rising it, thinking that it will be a good breakout trade. And nowadays, if you notice carefully, that the players are here giving only the fake breakouts and quickly they reverse it. And every analyst who have been recommending the breakout trade earlier, about 6 months back or so, they are cautioning all the traders going for the breakout trade, because we need to identify how long they are going to sustain. So if you use the live market quote page and with the help of the time frame which is shown, you'll be able to easily find out what sort of move it is and then try to take the positions. You'll be able to see that the fear is not influencing you. And once you are not under the grip of fear, then automatically you become a professional trader. A professional is a one who does not express his emotions in public. No? He expresses a refined presentation, and that will give that impression that the professional is highly qualified, or the professional is not under the influence of emotion, and he will make only a straight through discussions and things like that. And later on, after the meeting, you just go and talk to him, then he will be a different person altogether. So a professional is a one, he is in a position to control his emotions, and he is not expressing emotions to outsiders, and he does not expect another businessman to share his feelings. So if you are in a position to control your emotions, if you are not willing to share your emotions, that means you will not simply put in your in fxtrade.net chat and other places where the public forum is there. If you simply say, what a hike, what a spike, wow, if you do give such expressions, that means you are sharing your emotions with others. That means you are not a professional. And if you want to really control it and say, okay, they have been and they gained about 40 pips, that means you look into the reality of it. You don't express your emotions. You just look into it, okay, they had done 15 pips rise to make a drop. That is a stop point. You can easily recognize it. You are not under the grip of emotions. So try to see that you get rid of that emotional influence on your trading. Then automatically you'll find that you are able to understand these type of swings they are making in the market. See, day in and day out, they are making only these sort of moves. And you don't come across any other move in the market. And then finally, that extended stop, and they do it during the trend reversal move that I have mentioned here. That is for about 1.5 hours to 2 hours, a quick 150 pips rise and then reverse. That happens during the trend reversal time. It happens once a month during the month beginning or the month end time. So these are all the type of moves they do it. And I have been watching it for more than 20 years, and they are not able to change their attitude, or they are not able to change their practice. Even though I am talking in FX Street and it is in a public forum, they are not in a position to do anything else. So that means that is the limitation. So make use of it. Then, after doing all the studies, if you try to limit the risk using the hedging or the entry stop, in some platform is called it, and in MetaTrader 4 it is called as a buy stop or the sell stop. and that if you can use it, and you will be able to, instead of stop, you will be able to really limit the risk. Suppose you take a sell position and 1.3557 and keep an entry stop or the buy stop. If it is a sell position, a buy stop, and if it is a buy position, a sell stop below that. And that means what? If the market goes against in 30 minutes, and if the market goes against me 30 pips, immediately my position will be hedged. That means it will open the buy stop or the sell stop. Buy stop on the higher side, sell stop on the lower side. So I will have two positions. And if I use the stop, what happens? The stop will close my position. So I will not be having any fresh position. I have to think of a new position. And if you are under the influence of fear, what happens? Then you hesitate taking another position. And you think that, okay, it is better to avoid during the data release time. So let the market calm down, and later on I'll take the positions so that I'll do only scalp for 5 pips, 2 pips, 3 pips, and things like that. So you take one decision of that nature and try to take a position. When the scalping is going good, okay, I'm able to earn 10 pips, 3 pips, 5 pips. Okay, let me increase the quantity so that I'll take 10 lots and take 10 pips. I'll make 100 pips. Then take 10 lots, the market goes again straight away, account is closed. Simple. So if you become emotional, you are not even able to control your trades, and you don't have a systematic plan of trading. So if you use the hedging, okay, you take 10 lots if the equity is very big, and if the hedge is filled, then you have time to review whether the hedging is filled during stop and or during that of the false move, or during that of the extended move or the intentional move. How will be able to differentiate? If it is a stop and or an extended move, the hedging will be making loss. If it is an intentional move, the hedging will be making profit after 30 minutes. So if the hedging is making profit, it's simple. You keep stop at entry there. Let them take the market 100 pips. Like Friday, you have taken their sell position at euro at 1.3570 when they just breached the initial low after the non-farm payroll announcement. It came down to 1.35. Out of greed, you did not book profit. Okay, you did not also keep stop at entry, thinking that it will come down again. So it went up to 1.36. At least we have got the hedging order. If it is hedged and they have gone up, and it has gone up to that 1.3660, fine. I have got a sell around 1.3570, 1.36. I have the hedge order or the buy stop that was filled, and that's making profit. I understand that, okay, they are making it move against my expectations, fine. But I have not lost my position, and I have only locked 30 pips. Okay, they found the new high. Yesterday also they just came up to that 1.3668. And then afterwards they started making the slide. I'll keep simply at 1.3600 a stop at entry. And once they breach my stop at the entry, then comes down, I'll be able to book profit on my sell side. Keep stop at the entry at the sell side, and I'll become cautious in booking profit on the downside. So if you use the hedging, you have got time to maneuver and find out how exactly they are going to make the moves in the market. And you will be able to really capture good profit, even though at times the trade becomes a bad trade. And there is no point in telling that I had taken a sell position, the market came as per my expectation, but reverse. No, it is unexpected market. Market is, the manipulators are there. They are after the money of the traders. I can say for hours together, they are for the money, they are for the money. But I have come to the market to earn my money. What is the use of simply yelling at them? So they are doing their job to make their money. So I should be smart enough to capture some profit out of such moves, understanding their intentions. So if I failed booking profit, I find out what they are doing it. And in case if they have gone to 1.363738, doesn't matter. I'll simply close my sell position with 30 pips loss, accepting 30 pips loss. It is similar to that of keeping a stop of 30 pips, and it would have filled. But if I had kept the stop on that day and it was filled and then market went up and came down today, I would have repented. So I could have kept the position even though I got sizable equity. I could have simply kept the position. I would have made money. So many people regret with regard to the trades. So to avoid that hasty decisions and to repent later on such regrets, the best thing is use the hedging order. The hedging order is available in the European trading platforms. So, and also many of the US trading platforms, they have started introducing this hedging facility as a buy stop and the sell stop. Try to make use of it instead of stop so that you will develop the feel to keep the stop to limit the risk. Because if it is a mere stop, then people hesitate keeping it because invariably you come across the traders hit your stop and reverse the market. That is why traders hesitate keeping the stop. But if you use the hedging order, then such hesitation need not be there. Because if it is hedged, you can watch for 10 to 30 minutes. And if the hedging is making profit, if the hedging is making loss for 30 minutes, that means it was filled during stop and or the extended move. You simply close it and keep another hedge order 20 pips or 10 pips above. And once they start coming down, you keep lower the stop. Then also the hedging can be used to hold the position for some time and you can review. And in the event, if the market is going against your expectations suddenly after the because of the data release or because of the sudden event change, etc., then you can simply close your sell position and maximize the profit on the buy side. Or if you feel that market means swing, it has to go up and come down alternatively. If not today, tomorrow it is going to come down. So let me hold both the positions. I'll book happily profit on the sell side as well as the buy side. You do either way trades. If you have got a perfect understanding of the market, then you will not become afraid at all. You will not talk simply that euro, in spite of all the problems in eurozone, euro has to go up, or in spite of all the problem in US, the US has to go up. If you say like that, that is not going to help you. And no government is interested in our advice. First of all, we have to understand no government is interested in our advice. So we are only giving the advice to each other. And in that, how much of advice is being taken or taken into consideration, we do not know. So we have to really understand that whatever we say, we should be able to really beneficial to somebody. And if I simply go on tell something which is really distracting other, it is a sin. So let me not go beyond that. So anyhow, people are giving the forecast and other things and also analysis, etc. Many of the occasions we come across that they are really distracting to the traders, and because of that the traders lose. That's why I feel very bad that why the traders are being misguided in such a way, thereby the traders continue to lose. Especially those who come as a beginner, they simply lose the money by depending on somebody. And it's really painful. And they come to the market in order to earn small money to meet up their extra expenses, etc., or fix the liabilities, but they become really in troublesome conditions. Now let us go to that of the trading ideas. After understood the type of moves, they have already made the moves in the case of Euro GBP. And Euro, you will notice that they just breached the new low by 2 pips after 2 hours. So that means they will make an intentional downward move. But this intentional downward move, they will just drop it during the late European session. So just to show that it is an intentional move, I'll try to take sell position after that drop, which I don't recommend at all, but for the sake of proving that type of move, I'm just taking a sell position at 1.3555 with an entry stop or the buy stop 30 pips above. In GBP again, they have been holding it and they have come slightly lower. So I'll take a sell position. But normally what I do is I keep about 5-10 pips above that of the market SL order, so that if they swing, we'll be able to see that our entry is really fine-tuned. We get the best sell level at a given time. And if I keep nowadays the volume is so less, the market is not even making 2-3 pip swings. So there's no point in taking such orders. So depending upon the market condition, we have to modify our trading strategy. But 1.6797, I'll take a sell position. With 30 pips entry stop. But in the case of USDN, they not breach the low. So that means after an extended move, they wanted to gain the level slowly in the case of USDN. So CHF, they are closer to the high, and they just breached the initial high and gone above, and they are near the high. CHF, that will not give much of a profit. We'll go in for a USD CAD, which is closer to the low. So I'm doing a technical buy above the initial high, 1.0909 in the case of USD CAD. So it will be 1.0914. With 30 pips sell stop. Okay. So these are all the three positions. And as I explained that Euro Yen and GBP, they are making a downward move. But first of all, you have to see that they are making about 70 pips spread between the high and the low in the respective currencies to take positions. And only then you will be able to really make substantial profit. Otherwise, they will give only 5-10 pips profit. But just because it is a webinar, I am trying to take some positions and show it to you. But otherwise, wait for such good moves. If the spread becomes more than 70 pips in the case of crosses, more than 40 pips in the case of majors, then take the positions. You will be able to really see nice profit in that. So Euro Yen and GBP, they just made around 70 pips, but they are holding it. So a small pullback, we'll try to take a sell. In the case of Euro Yen, so 138.74 is the current level. So 138.74 is the current level. I'm keeping a sell limit 138.86, about 10 to 12 pips above that, so that when they make a small firm up and then drop, we will get our order filled. Then it becomes a position, and we can keep the buy stop above. Even though it is only a limit order, still we can keep the buy stop only when it is the sell limit is filled, the market can go up and fill our buy stock. The limit is not filled, obviously the market is not going to fill our buy stock. So even though it is only an order, still you can keep 50 pips above the hedge order or the buy stock. In the case of crosses, we need to keep 50 pips hedge order. So these are all the positions I had taken, and now you can just watch how exactly the market is making the moves, and you can watch it carefully and find now euro is in 2 pips loss, and GBP is also in 2 pips loss. And so it will be like that, and later on you will find we have got the hedge orders to limit, so that we will be able to find out whether we are in the money or not. So I will come back by 13 GMT and show to you the results of these trades. So before that, I'll answer the questions which are asked here. Okay, there is a practical questions from Gregory John. How do you manage to make a decent living from? I also use hedging. I'm using the hedging and also making a decent income out of the trading, and also through my website I'm training people to trade, and also in the managed accounts, and people are really happy with that trading. So we will be able to really earn good money. And see, the way in which judges ask the question is very doubtful whether anybody can make a full-time trading. And one can do full-time trading. It doesn't mean that he has to be glued to the market all the 24 hours. He can just look into the market whenever needed, and also look for some of the prime events during which you will find that the false move before the data release time. And when they make a false downward move, you take a buy, then quickly they will make an upward move and you can book profit. That sort of opportunity trading, if you try to do it, you'll be able to really make good profit from the market. Then Nadine, please tell me what to do with a pair like AUD here, which is in mid position between the high and the low. Okay, now Australian dollar, they are just making a narrow range swing here, 93.41, 93.76, and 93.63 was the initial high. They just went up and come down. And definitely, if you grumble during the mid session, nothing can be done. But if you wait for the late session, they will make quick downward move, book profit. See, you have to understand, first of all, the momentum of the currency pair and then accept the profit. And if you expect about 100 pips profit in a dull market, then it might give you only surprise. It will again go up. So they have been doing the downward move in Aussie for many times. And some of the days you come across the sideways moves. And today they are expected to make a drop. Once they make a drop, at least keep stop at entry, so that next time when they rise, your stop will be filled and the new high will be shown. You can take a sell position again. So you don't lose anything on that. So you have to follow any of the trading system. Once the position makes profit, keep stop at entry and then try to do a position trade. You simply take a position and expect that position to make a big profit without any trading strategy. You need to have enormous tolerance and patience. So you should be able to tolerate when the market goes against you, and later on when they show a massive profit, you should be able to use the trailing stop and book the profit. Instead, do many swing trades and earn that money. So Aussie is expected to make the slide by late European. I'll come back by 13 GMT and show you how exactly, and refer to the current levels, the US session, that is gap time levels, and we can find out what sort of moves they have done it in the market. Then MRC, the spread between what levels? Between the high and the low. Between the high and the low should be 40 pips in order to enter into the currency in the case of majors, and 70 pips in the case of crosses. Any other questions? Okay, fine. Then I'll come back by 13 GMT and I will explain to you what happened to the positions, what I committed now, and whether they are in profit or whether they are hedged. I'll explain to you how I am going to handle those positions so that we'll be able to really understand when the market moves in our favor or when the market moves against, I don't become afraid. I am only identifying them as good trading opportunities. So that is how we have to look into the market. If you continue to look at the market as a surprise, then it will build up enormous tension. If you look into the market with a perception that it gives enormous trading opportunities, your mind will be able to look into that of such opportunities and you will be able to really recognize it. Otherwise, most of the opportunity will be simply missed opportunities if you are afraid. Then I also review during the gap time what happened to the highs and the lows, what they are set it now, current highs and the lows, and also the initial lows and the high, and find out what they are trying to do in the market from time to time. So try to learn in a very simple way how the players can be tracked. Then you can really make use of it to consistently earn money. You will not spend much time in doing your analysis. You will be able to spend a smart, valuable time in doing some good quality trades. So look for such trades rather than simply hold the position for several days without any profit and say that I am only doing position trade. And so don't try to cheat yourself and try to see that you are able to earn money. That is the prime objective of coming to the market. And don't get deviated from that. And there is no point in becoming an expert in giving a technical analysis or fundamental analysis and things like that. And you can only give it free of cost to others. But if you trade, you will be able to earn. For that, you develop a good system for yourself. Thank you, one and all. See you by 13 GMT.